Hi, welcome back to this investing guide, and we are now in chapter 2, and we're going to talk about asset allocation level 1. And a short recap, what did we discuss in chapter 1? In chapter 1, our main conclusion was that most people should mostly use a low-cost, worldwide diversified ETF to generate returns for their portfolios. And if you haven't seen that, you can watch this video there. And scientific basis and source for most of the guide right now is gonna be this book here. And for this presentation, specifically chapter 10.2, determine your level 1 asset allocation. And as discussed in chapter 1, we're gonna use mostly this book because right now in Germany, I would say for scientific basis of passive investing with ETFs, this is the go-to book right now. And also this time I changed my presentation style from last time, now using PowerPoint, so let me know if you like that or which presentation style you prefer. And also, small caveat, this is no professional financial advice. All the information here is to the best of my knowledge, but of course there can be mistakes, and maybe if you watch this video in the future, there might be some updates or some things change. So always also do your own research before doing any life-altering financial decisions, please. And additionally, this is a small channel, no one watches these videos, no one subscribes. So if you have a question, even if it is longer, just post it in the comments, and chances are high that I will have time to answer you. And of course I will if I'm able to answer your question. So, starting with the basics. We have money, we want to invest. What should we do first? In the beginning, we should build up a liquidity reserve. Before we even start investing, build up liquidity reserve. And this helps buffer against unexpected expenses. What could this be? For example, our phone breaks, falls down, or somehow we flush it down the toilet or something. And it's important, like for many people, if you use a smartphone nowadays, it will be important to get a new phone or a replacement or repair the phone quickly to be able to participate in social life. And oftentimes, people also conduct their work and business over a phone. So just running around half a year without a phone will not be a good option for most people. Or it could also be that our washing machine, which we need, goes broke, or maybe we lose our job because we are stuck in the washing machine for too long because we are trying to find the socks that went missing in the washing machine or something. So in general, unexpected costs can happen to all of us, even if we try our best to avoid them. That's why they are called unexpected, because we cannot expect them. Or we can expect that unexpected things will happen, but of course this only helps so much. So why are unexpected expenses bad? Well, we don't have enough money on our bank account. This can lead to us having to overdraft our banking account. And I don't think I will have to go into much scientific detail for that. For most banks, the overdrafting interest is quite high. So of course it is logical, if you want to optimize our own personal cash flow, that we want to avoid using overdrafts if we can. Which we can, and for example our phone breaks down or our washing machine, we can avoid this by having a liquidity reserve. Then also what we avoid with that is having to sell off ETFs. Let's say, you have a portfolio of 10,000 euros, but you want to maximize your profits. You invest everything in ETFs, go YOLO and hope that, nothing bad will happen. But then your washing machine is dead. You have to buy a new one for 1,000 euros. And then to buy the new washing machine, you would have to sell off a certain percentage of your ETF portfolio, which would result in realizing potential losses you could have incurred during this time. And also this would reduce tax efficiency in many cases. Of course, this will depend on your own tax situation, but in most countries it will be not that efficient. And of course, with a liquidity reserve, what is important for many, not all, but for most people, I would think mental stability. That, we have the knowledge that if our phone breaks down or something, that it is easy for us to replace, or if we lose our job, that we have enough money to survive. Of course, it will depend where you live. For example, in Germany, if you lose your job, mostly government will try to take care of you. If you live in America, the social net might be not that great, so it's actually more dangerous if you lose your job and don't have enough money and you have no friends or family to help you out. So keep that in mind as well. And how big should this liquidity reserve be? So Comma recommends average cost of living per month times 4 or 10. And the important part for this kind of money is that it is safe and that it is very liquid, that if we need it short term, that we can access it very fast. And my own small comment for that is make it as big as it has to be, so we can cover the most likely unexpected expenses, and also for us to feel safe, but also at the same time try to make it as small as it can be, because everything we have in the liquidity reserve will not be in our normal portfolio, which will ideally generate in the long-term returns for us. So we will be missing out long-term on these returns for everything we have in the liquidity reserve. Don't stress too much about finding the perfect amount of money to put in the liquidity reserve. Just come up with something and see if it works for you or not. And also with this small comment, depending, how you are dealing with financial stress and your outlook on that and your personal situation, this could be higher or also lower. For example, if you have family members or friends who 100% would be able to help you out, if you have an unexpected expense like having to buy a new phone or washing machine, the number would be maybe smaller. While if you're just on your own, you don't have any family who could help you out, maybe you're living in a state that does, in a country that doesn't have a lot of social welfare, and if you lose your job, you're just on your own, then maybe the liquidity reserve should be higher, more in the higher range, and maybe also higher than times 10. But you have to figure this out for your own. And of course, if you have your liquidity reserve, you can adjust. If you notice, oh shit, I thought I just need a very small liquidity reserve, but now I had an unexpected expense and I was like, oh wow, now I don't have any money left in the account anymore, maybe consider upping up your liquidity reserve. But also it could be the situation you at the beginning are very afraid, have a lot of financial stress, have a very high liquidity reserve, but then after some years you figure out, hey, I always had this high liquidity reserve, and now when I just think about all the returns I missed out, and I actually, for my situation, it's not that realistic that I would need all of this money in my liquidity reserve, then of course you can also try to hold less money in your liquidity reserve. And of course, the liquidity reserve is something that is supposed to be for emergencies. Ideally, the idea of this liquidity reserve is just use it if you really have to. Ideally, you will not touch the liquidity reserve in the next 10 years. This is not supposed to be an normal thing that you have to eat into your liquidity reserve. Ideally, most of that expensive, you get your paycheck, you lose your phone or the washing machine breaks, then ideally you can pay this from your normal cash flow. Or your washing machine breaks for the 1 month but unfortunately you just spend all your salary on like a new Porsche or something, you can try to survive without the washing machine. And if you get your new salary, you buy the new washing machine. And of course, once we have filled up our liquidity reserve and we have more money available, we can imagine it like it overflowing. We have to, then the rest we put into our portfolio. And what this level 1 asset allocation, the L1AA, is all about is deciding which percentage we should and want to put into the risky part of our portfolio and how much we should put into the low risk part of our portfolio. And how to think about this decision. If we, imagine the return of investment of our portfolio like a whip, the more risky portfolio share we put, the more return of investment long-term we will generate. And the low-risk portfolio share will drag this down in the long term. So why would we just not put everything 100% into the risky portfolio share then, to maximize our return of investment in the long term? So of course, like stocks and ETFs, they earn the highest return of investment on average of any asset class, but this return is not for free. The reason why they earn these kind of returns is because they're very volatile. They're very risky in the short term. And short term in the sense, I think, can be longer than the normal average investor might consider. So the longest zero return period, inflation adjusted, for US stocks was 14.3 years until March 1983. So nearly 15 years of a zero return period. And the reason why we choose US stocks, as an example, is because before 1970 there was only yearly instead of monthly data for international stocks. But of course, while this sounds really bad, and of course it is, you also have to keep in mind that this is a worst case scenario. So for a person that invested into US stocks to actually have the 14.3 years of zero return would mean in actuality that they invested all their money on the worst day when the stock market was very high, and then again sold off all or had to wait 14.3 years to get to zero for their returns again. Which of course it can happen, and many people invest in the stock market, so it happened maybe to some. But of course for many people, for many more realistic investing scenarios, if people invest, they will get their salary monthly and invest their salary on a monthly basis. And once you start selling off parts of your portfolios, most people will not do it just on one day. They will also sell off their portfolio in steps. So the likelihood of a person actually having 14.3 years of their portfolio not getting any returns is in real life, of course, not that high and lower. But still, says, historically a nominal zero return period for a 100% stock portfolio of 10 or 12 years has occurred several times in the past 100 years. And you must always be prepared for this with your stock portion of your portfolio to happen. So of course, 14.3 years, at least from the historical data we have, it does not seem that likely for you to happen, but 10 to 12 years, this kind of zero return periods have happened multiple times. So it is something we should not be very surprised if it actually happened to us. So of course, now coming back to the question, how much risky part we should put into our portfolio. And if one of you has thought, maybe I just put 100% into the risky part. Maybe after getting this information you will think a little bit different about it, because the returns for the stock market and ETFs is maybe a little bit lower than many people expect. And also the time where you can have a zero return period for many portfolios is also longer than people expect most of the time. Of course, all of this to say is I don't want to discourage people from putting like 100% of their portfolio into risky assets if it makes sense in their situation. But this information, I think, is helpful to know what we can expect, what might be realistic for future scenarios of our investing journey and for our future portfolios. So what does this tell us about the ideal composition? How much money should we put into the risky part? Well, ideally, 100% of the money that is not needed for your chosen time frame is put into the risky portfolio share. And chosen time frame because, well, Comma said worst case scenario was 4.3 years, and more likely is going to be like 10 or 12 years. So if you are more risk averse, maybe consider more like 12 years. And if you are able to handle risk better, then maybe think of 10 years. And also this 10 or 12 years are for the zero return period, so worst case scenario, which for most investors is unlikely. And if you're not investing and pulling out your money all at the same time, it makes it even more unlikely. So if you're able to handle financial stress well, you could also consider choosing a time frame lower than 10 years. But of course, with the historic worst case scenario, we have to keep in mind, well, that was the history. This is what happened before. And of course, we all would hope that the future for us looks bright. But of course, it can also be happen that in the future, everything goes down the drain. Maybe World War III happens, a new pandemic. And then, of course, we could look at a future where that could potentially much worse than what happened before. Of course, this will probably be reflected in the stock market, but of course, unfortunately, it can happen. And if there's a World War III and everything escalates, maybe we're all dead and the stock market doesn't exist in like 10 or 20 years. Well, I hope this likelihood of that to happen is very, very low. But of course, there is a future that could happen. And depending on your own appetite for risk, choose the time frame here accordingly to that. So what are potential good reasons to mix in low risk portfolio shares? Well, if we find out that a 100% risky portfolio is too risky for us, for our own appetite, or also for our own financial situation, it makes sense to mix in some risk-free part as well, so that the total of our portfolio achieves a lower desired overall portfolio risk. So we can think of mixing the risky and safe part of the portfolio similar to like mixing our own, like choosing our alcohol percentage when we mix our own cocktail. So if you go 100% alcohol, like probably the night is gonna be fun and crazy, but the likelihood of us also like having a really bad night and maybe getting a hangover and crashing and puking all around is also higher. And if you go to the party during the night and think, hey, for me it's more important to have a good time, and not run, like maybe I'm not looking for the night that's gonna be absolutely crazy, I just wanna have a good time, then of course it makes sense to mix in like, a safe amount of like more juice into your cocktail. And another good reason for us to include higher percentage of safe parts into our portfolio is actually psychological stress. So the maximum drawdown for the US stocks, inflation adjusted, was until June 1982. 1982, yeah. And even though the research from Kammer and colleagues indicate that during this time frame, a worldwide diversified portfolio would have had a lower drawdown, we can still also look at the data from the MSCI ACWI, which is an index which covers approximately 99% of the global equity investment opportunity. So a good representation of the worldwide of the worldwide economy and returns we can expect if you invest in a worldwide diversified ETF. And of course, here the reason again is that for the time before like 1970s, for the worldwide ETFs, we only have like yearly data instead of the monthly data we have on the US stocks. And even then, for the shorter like time frame, we can observe all the data for like global indices like the MSCI ACWI. It's even like still like around 60%. So of course you try to make up your thoughts about which, time horizon you feel like you should choose, which time horizon you feel comfortable with, like from Kammer, around 10 or 12 years, maybe more, maybe less. And like that, you should choose how like all the money you don't need during this time frame, put it into the risky part of the portfolio. But of course, if you have the situation that even in your worldwide diversified ETF, it goes down like nearly 60%, for many people, this will stress them out, especially now with the new broker apps. Instead of checking your portfolio like few times per month, now we always have it on the phone. If it goes down, we can check immediately. Many people will be stressed out by that. Some people, if they see their portfolio goes down nearly 60%, they will not be able to sleep well anymore. And at the end of the day, optimizing our portfolio, it's not just for optimizing our return of investment, but at the end of the day, what counts is like our life quality, how much we can actually enjoy having this portfolio. And some people, they can, just invest like a machine. They say, well, I know the science behind it. So if I think, well, a good time frame for me would be like 10 years, then I will just put all the money I don't need for the next 10 years into the ETF. And I don't care if it goes like down minus 60%, minus 80%. I know my science and I, trust in that, and I don't mind too much about it. But some people, even if you know the science and that all the historic data speaks for, that they shouldn't worry too much about it, they still, cannot handle financial stress that well. And seeing their portfolio going down like 60%, will have major negative impact on their life satisfaction. So if you see these red numbers and you think, oh my, I don't think I could, if this actually happened to my own portfolio, I could not deal that well with that, then maybe it's time also consider like psychological impacts of financial stress as well. And similar how it goes for people in the like fitness influencer space, optimal does not always mean realistic. For you, maybe like it would be optimal maybe to put all the money you don't need for the next 12 years into the risky part of your portfolio. But at the end of the day, if you think, well, there's a likelihood that my portfolio goes down 30%, 50%, and this would stress you so much that you could not endure it, that you would actually sell off all your portfolio while the market is down, that it is much better to be honest to yourself. If you don't think you could handle this kind of stress that might like financial stress that is likely to happen to the risky part of your portfolio, it is much wiser to have a higher amount of the safe part of your portfolio. It is better, of course, every part of the portfolio that you do not put into the risky part where you invest in ETFs and similar to generate long-term returns. Of course, in the long term, you will have less returns, but it is much better to have slightly lower return of investment in the long run than running the risk of being too stressed out during the next financial crash, not able to sleep and selling off at the worst time while the market is down and giving up of investing into the stock market in general. So yeah, in this case, better be safe than sorry. And also you can go a strategy, if you're at the beginning, you haven't invested at all, and you feel scared about it, and you think, well, if the risky part of the portfolio goes down 50%, I could not deal well with that. Well, then choose to put more of your portfolio into the risk-free part of your portfolio. But maybe after 5-10 years, you get more confident with investing and also the science behind it. So then you are more confident passive investor. Then of course, later on, no one prohibits you from just switching up your percentage distribution. If you feel more confident, put more part of your portfolio into the risky part of your portfolio. And of course, the other way goes around as well. Well, you think, well, I'm young, I'm educated in the finance space, and I think I can handle a portfolio that is 100% invested into the risky part of my portfolio. But then it turns out, well, during the next financial crash, actually you're too stressed. You actually consider selling off everything, and you can only stop yourself by a small margin of losing your shit. Then in the future, redistribute, put more of your money into the safe part. So what could this So, Comma calculated a risky and risk-free percentage table to guide our decision depending on the maximum drawdown. He has calculated 11 different levels using a time frame longer than 50 years. And we can also see over the time he changes the index he uses, not because he wants to, get to a certain result, but the longer the time goes on, the more data we have available. So at the beginning, it's just MSCI ACWI, and afterwards he's able to switch to the EMI version, which includes even more assets for the worldwide investing universe. And in this case, because he's a German writing a German book, he uses for the risk-free part of his portfolio German government bonds and the German money market. Which is a small caveat. Of course, if you're not planning to invest into the German money market and in German government bonds, your table might look a little bit different. But in general, I think these are good proxies for a safe part of your portfolio, which are about liquidity and safety. And of course, if you use other bonds from other countries and a different percentage, that might change, but I don't think the recommendations would change too much. And of course, he uses the 3-month Euribor after 1998. And the data sources, he says, are from MSCI and Deutsche Bundesbank. So trustworthy sources for that. And there are also some boring assumptions we have to talk about. So this table is for normal valuation levels of the global equity market and a slightly higher valuation for the bond market, which was the case in August 2024. And of course, he writes a book, so he cannot update this like on real time. So once you see this video, of course, do your own research and check if these assumptions still hold true. And if the valuation levels are a lot different, then maybe the table will not be that, dependable anymore. But of course, if these levels change drastically a lot and the situation for investing in general will change, it is also safe to assume that Commer might also publish a new book with a new table, and we can talk about it if that is the case. Yeah. So, of course, could have changed significantly, and then it might not apply any longer. Yeah, and of course he also says, well, the starting levels for the equity and bond market, they are important for the calculation as well. Then additionally, in the table, we will also find different numbers for factor investing. And factor investing, they try to use like an investment strategy to, have more of like stocks that are good in certain factors like value, momentum, quality, size, and low volatility. And in general, like factor investing, it's more topic we will discuss later on in chapter 3 if we talk about like which additional parts to include in our portfolio. Factor investing is something Commer suggests, but it has lower diversification, higher volatility probably, and Commer thinks there's gonna be chance for higher long-term return of investment, but for me, at least right now, I'm not that convinced of that. And if you're right now a little bit confused what this is supposed to be, there's gonna be more information about factor investing in the future. The only reason I'm talking about it now is because it is included in the table of Commer. So then I will also already include it now. So if you have to come back after making a decision, if you want to include factor investing or not, it's already there in chapter 2 for you to reference. And of course, disadvantage for factor investing would be additional cost as well. Then what is for the table? He does not list an additional table for ESG investing, but we can assume that if you, in one of the later chapters, choose to use an ETF to invest primarily into ESG, then like ESG stocks, that we can assume that the returns would probably very similar, maybe a little bit reduced return of investment. And now let's have a look at this table. So it's from Commer, page 456. So and here we can see the percentage of the risky part of the portfolio. And here is the low risk part of the portfolio. And of course, together it will always be 100%. So here it's 100% risky, so it must be 0% for the low risk part. And then he calculates this in 10 percentage steps. So here it's now 90% risky part of the portfolio. So we must have 10% in the low risk part of our portfolio. And with the 10 steps, 11 different numbers he calculated, I will show you the other part of the table later. It gives a good overview of different percentages. So here is now the important part. We can see the maximum drawdown in nominal version, which we would expect, which for 100% risky portfolio would be around 50%. And logically, the more safe part of the portfolio we put into, the lower the maximum drawdown will be. And here you have the two versions, market neutral investing, which I would probably recommend and I think is more realistic. But of course, the people that are into factor investing and also subscribe to the idea of common and believe in factor investing, at least these are the numbers, things are likely for factor investing, which he thinks will be higher than for market neutral investing. So if you need to reference this, maybe take a screenshot. And here is the second part of the table. And of course, at the end for version number 11, we are at 100% just invested into the safe part of the portfolio. And for the last two numbers, we only have a maximum drawdown of -2%. So think about your own appetite for risk, your own financial situation. And if you think 100%, the maximum drawdown of the 100% risky portfolio is too much, think about maximum drawdown you are able to withstand and choose your portfolio asset allocation accordingly. But of course, at the same time that we reduce the maximum drawdown, we reduce the volatility. Also, of course, the expected return, real return, before cost and taxes will go down with that as well. So if you now think, still we have the guideline of 10 or 12 years to put everything into the risky part of your portfolio. And then we have the situation, you don't think you're able to hold even if it makes sense, you don't need the money for the next 10 or 12 years, you're not able to withstand the financial stress of your portfolio going down 50 or 60%, then of course accordingly to that choose a maximum drawdown you think will be likely and you will be able to withstand, and mix in safe parts of your portfolio accordingly. And of course then the second situation where it makes sense to mix in safe parts into your portfolio as well is, of course, let's say you have a portfolio and from that portfolio you wanna finance your kid going to school, buying a house or buying the next sports car you want to buy, and you don't want your portfolio to drop under a certain value, then of course you can do some simple math and try to find out which composition to choose so you can guarantee that your portfolio will not drop. Let's say tuition for a child costs 100,000 euro, then calculate and make sure that your portfolio in the next years will not drop down under the 100,000, and choose your portfolio composition accordingly for that. So the presentation was longer than expected. So now in a nutshell, save up a liquidity reserve. Strategy 1, you are a robot, you don't have any emotions. You just do what science tells you how to achieve the highest possible return for your portfolio. In this case, invest all the money you don't need for the next 10 or 12 years into the risky part of your portfolio. But even if you're just a robot, if a vital expense is coming up, like sending your child to university or fulfilling your dream of living in your own house, then consider historic worst case scenarios we had with the US stock market and also the international indices like ACWI. And consider adding a buffer. And also consider the possibility that with all the worst case scenarios we had historically, future might look even worse than that. Then strategy 2, you have a lower risk tolerance in general, or you expect a high expense before the 10 or 12 years or whichever number you can up with. In this case, Decide which maximal drawdown is acceptable for you in your situation, and select portfolio composition from the list I showed you before that makes sense for you. And of course, important, check if the assumptions still hold true, and if not, try to find more up-to-date information. For this long presentation, if you have any questions, then of course, as I said in the beginning, feel free to ask me in the comments, and feedback is welcome as well. Today I tried a different presentation style, which I think is already better than the first video I did, but of course in general there is still a lot to improve with my presentation style, audio quality, and also, speaking freely. So, what is next? We're gonna have chapter 3, and we're gonna talk about level asset allocation 2, L2AA. What is that? Well, now we consider the broad strategy, how much percentage to put into the risky part of the portfolio, how much percentage to put into the low risk part of our portfolio. From chapter 1, we already know a risky part of the portfolio will probably include a lot of ETF, worldwide and diversified. But what else? What else can or should we mix into the risky part of our portfolio? And what should we put into our safe part of the portfolio? We will talk about that. Considerations for that. And of course, then after chapter 3, we will hopefully at some point get to the fun stuff, which is choosing the concrete products and showing how to actually sign up for a broker and use a broker in general. And of course, if there's anything else specifically you want to know, we will be able to talk about this as well. And after we have the general structure in place for the course, we can also do more deep dives. For example, have a very long discussion about the usefulness of ESG investing. Does it make sense? Or about factor investing as well. Because these topics, we can talk about them shortly in this guide. But of course, if you want to go really in depth with them, you could do your own entire series just about factor investing or just about ESG investing, probably. So then, click the next video.